Good afternoon, this is Chris Brecher doing the premium option video today for Triple Witching, September 15th, 2023. What was today about? Open interest. That's really what today was all about, is no matter what everybody said about big open interest at 4,500, that has hardly ever worked in the SPX. Let me show you what we're talking about in here. So the SPX today got destroyed down 54 points. The reason I'm showing you this, as you see it closed at 44.50, is almost every triple witching, the open interest doesn't matter. So right now, the big old open interest was not at 4,500. Just keep in mind, it wasn't at 4,500. It was at 4,500 for the options that expired today, last night. The AMs. So this is what happened, is there's a thing called settlement. So the SPX AM options closed last night at 4:15 Eastern. That's the last time to be able to trade them. But the settlement for it is today. So as you see, the SPX was down 54. And you're going to see, if I go back to the Analyze tab and go to the SPX from yesterday, and you're going to see the AM options. And the reason I'm showing you the AM options is I want to show you the open interest. And you're going to see it's at 4,500, it's gigantic, 63 and 61. But that's yesterday. So those expire this morning. So the S&P kept going, but let's see what the settlement was. That's where, if you had some spread last night, it'll tell you where it closed. Survey says 44.91. So that's the point. It was relatively close. Keep that in mind. The SPX last night was relatively close because the AM options expire. But the SPX itself on triple witching very rarely goes to the big open interest. So let's go through it and I'll show you what we're talking about. So the first thing we're going to do in here is we're going to go to on demand. And we're going to go back to the last expiration. So I want to show you this. I also want to show you Meta. Now, don't get me wrong. I didn't do it perfect today, even though I called it, because it did what it did August 10th and and September 8th. But we'll go into that in a minute, and then I'll go over what I think is going to happen next week. This is last expiration, not triple witching, but the third Friday of the month. And we're going to go to August 17th. And you're going to see in here on August 17th, and let me see if I get it working right, that August 18th was expiration. So here's the 17th and the AM options that expire. Now, when you go into this, and I'm going to go just 14, so it doesn't mess you up with too many. And you're going to see the 4,400 had a lot, 20,013, not that much. But the point is that the next day, which is August 18th, the PM, didn't have many anywhere. And the moral of the story is, if you go to the next day at the close, so you're going to 1637 military time Eastern, and you go to the 18th, I hope I'm right, but I've already looked up a lot of these. But you'll see the numbers, it's variable. It's not a layup. It's not a layup whatsoever into this. So that's the one thing. Of course, it has to work real slow when I'm trying to get this on for you, but there you go. Not near anything. Not near anything. So you might say, well, how about the ones that have gigantic open interest prior to it, like triple witchings? So you go back to June. So June, July, August, September. It's always those quarters. And you go into the June 16th. And then we're going to go in and you're going to see that the open interest is very misleading. So that's the last triple witching, because that's the expiring of the options, the futures, and the index, the stock indexes. Go and look at this. 16. Those are the AMs that expired that morning. 43.50. Yeah, it didn't go to there. How about 4,400? Gigantic. Sort of went to there. No doubt about it. But there were a lot, I mean a lot, that thought it was going to 4,500. And it went down instead. There was open interest at both of them. If you go down to all of them, and you go into March, and you're going to see a number of them didn't go to the strike price. Sometimes they did, sometimes they didn't. But the moral of the story is you just have to trade them. I know that's corny, but you just can't go and be stubborn about a certain open interest. So let's go into it and I'll show you. There you go. That one hurt a ton of people. Do you see the down 43 right here? There were more people that thought it was going to 4,000. The 4,000 open interest wasn't big. 4,000, not 4,400. So let's go into this. And we'll go into 4,400 and I'll show you. So many people thought it would go to 4,400. We're going to scroll down. Sorry, it's a lot of strikes, lots of strikes. And you go to the 4,400. Look at that. You got the 13,000 and the 4,000. The 3,900, you had 5,000, 9,000. But that's not what people were looking at. They were looking at the AMs from the night before. And then when you go into that, and that's what I said, misleading, those options expire basically the night before. So let's go into the 3,900s, 51 and 65. Now, I might have been looking at the open interest wrong. I switched these around. How about the 4,000? Gigantic. 119,000, 123,000. And it didn't come close. Now, when you go back into these Marches and you go into those 4,400s and the 3,900s, like I said, I might have done this wrong instead of volume. And you're going to see the 3,900s. I was right, thank goodness. How about the 4,000s? There you go. 4,000, I was right, and 13. So the point is, it's variable. The other thing that you got to make a point, and a lot of people get this wrong, is the SPY itself. The SPY volume of the underlying instrument dwarfs the options. So if the options have big open interest at a certain price, that doesn't necessarily mean it's going there. And the reason is the open interest needs to be relative to the volume of the product. So when you go into the 390, look at that. 73 and 107. Yeah, that's great. Until you go into the 4,000, 103, 71. You didn't know which one it was going to. The 395, 43 and 56. It's variable. That's all I mean. And it's very difficult, especially when that closed at 395 and they had a lot of at the 400 and the 390. Very, very difficult in there. So how do you trade that kind of thing now that you know it's sort of variable? Well, let's go into it and I'll show you what we're talking about from today. The first thing to notice is that a number of stocks, so forget this for now. Forget this for now and realize that a ton of stocks had a lot of open interest under the market. They had a lot of open interest relative to their volume. So if they had a ton of open interest relative to their volume under the market, then it was more likely that they get pulled down. A lot of them were NASDAQ stocks. So I want to go through the steps on how we knew to stay short. So number one, the divergence between bonds and stocks. So I could go and show you here. Here is the ES. And you'll see the ES on a 4-hour chart is up here. Well, was up here. This morning. Up against resistance. I do these charts 3 times a week for our Chart Patterns Mastery Room, and I was noting that's that resistance. So number one was that resistance. Number two is the bond market is refusing to rally. So it's very difficult for the ES to get over resistance if the bond market is selling off. And the bond market was down this morning as well. So there's your first reason to be really cautious and not trust 4,500 on the indexes. The indexes, not the ES. So keep that in mind in there. The SPX, that's what we were looking at in here. So the next thing is the open interest. So I want to show you this open interest on a number of stocks. Now, amazingly, you had Amazon down 4. That's been one of the strongest stocks on the planet. And the open interest, yeah, you guessed it, was 140. Never thought it would go there. 39,000 and 28,000. That's a lot. How about Meta? Yeah, 300. 14,000 and 16,000. That was by far bigger than at 310. I looked for evenly dispersed open interest, and you just didn't have it there. There were a number of them that did this. Google. Now, this has onesies, so every one open interest. It's a pain in the rump, but you'll see that 137 and 137 and a half had more than 138. 138 had a lot on the call side, but not on the put. Why does that matter? Because it's spread traders that make something go to the open interest. So you want relatively evenly dispersed. There were a number of them. Disney, 85. Yeah, it opened over 86. A lot of us bought the 86 puts for under 35 cents. They went to $1.30. Microsoft, yeah, it's been a monster. Guess what? Tons of open interest at 330. Nobody thought it would go there. Evenly dispersed, 26,000 and 17,000 on the right. So they went there. So not only did you have them have open interest under the market, but you also had that the ES was in scary territory because it was so high relative to the bond market. So it was easier to develop a theory about the markets going down. Well, then you had that Microsoft's 330. Could you have played it when it was only down 5? So that's the next thing I want to show you. Here's Microsoft on a daily chart. Not a picture of beauty, no doubt about it. So the next thing is, what did a 1 minute or 2 minute look like this morning? Well, it gapped down. Don't get a real chance with that. But then you got these little bear flags in here. In fact, when I was on the Essentials room, a lot were asking me what I thought of that. And I said, it looks like a bear flag. And it's much more likely to break down if the bond market is still selling off, which is what happened. So Microsoft went down. Then I got to show you Meta. See that chart? That was almost impossible to get that move. That took about 3 minutes. It's really hard to short at 304 when it was just 310. But the wild thing is, it did the same thing last week, and it did the same thing on August 10th. Really wild stuff in there. So if you go and put a 5-minute chart, and you go back to last Friday, yep, there it is. But this one was 304, but a nice tight bear flag went right to the strike and then overshot. So very interesting on how many of these did that. Now, this is the next thing. What made the markets go down other than big open interest? What made the markets go down, in my opinion, is that a lot of individual indexes were over their 50 moving average. Over their 50. But other ones were under it decisively. The Russell, decisively under it. Always double check. But that's the 50 moving average on a daily. Decisively under it. The transports, decisively under it. So the theory is not the Dow theory that they have to go in junction with each other. But if some are decisively under it, then the other ones are probably going to get under it eventually. Go and look at the SPX. It started over it. It got under it. How about the NDX? Started over it, got under it. So now you see some of the reasons that we were bearish. Now, the thing is, though, the things that made the market go down, not only like algorithms that might have pulled things to the 50 moving average, but also because of the bond market. So this bond market, I'll put it side by side so you could sort of get an idea of what we're talking about. So on the right is going to be the long bond, the ZB. And I'm going to show that on a daily chart, and you see where it is, down in the catacombs, down here. On the other hand, you have the NDX all the way up here. So we could take it on a 4-hour. Maybe there's a different divergence. Nope. There is the ZB on a 4-hour in the catacombs. Here's the NDX on a 4-hour, way up here. So now the NDX finally got hit. Now, what does this mean? Means to me that unless the bond market, which to me is the thing that pulled down the NDX in the first place, until that really rallies and you see the NDX sell off, so you have a positive divergence between bonds and stocks, then this could have another leg down. So where is the leg down? Well, number one, keep in mind the FOMC statement is Wednesday. It's Wednesday at 2 p.m. Eastern. I'll be on the Chart Patterns Mastery Room, and I haven't seen the schedule. I might be on some other rooms. The thing is, a lot of people are saying the Fed is done tightening. The problem is long bonds hate inflation. This is why we've been bearish on bonds. This is the DBC, the Dow Jones Commodity Index ETF that includes oil. Now, you're not going to get the long bond going up if the commodities are going up. Long bonds hate inflation. So now comes the wild card. If the Fed says they're going to stop tightening, is the long bond really going to rally? No, it's going to go down because now they're not as vigilant against inflation. On the other hand, if they say they're going to tighten, just keep in mind the ES and the NASDAQ are really straight up considering where they were. So relative to bonds. Just keep in mind another thing. I'm sorry I keep mentioning bonds, but I traded on the floor a long time. And the key is there's an alternative to your money other than stocks, but you haven't been able to really tell yet. Bond market, that was August 21st. Stock market, that was August 21st. You sort of get the drift of where I'm looking at in here. Second thing you're going to watch, and this is what I'm going to be watching next week, is that trend line. I'm going to be watching the MACD. On the right, I'm going to watch the trend line on the NASDAQ. Not as clear cut. Not as clear cut. But if this trend line on the left breaks, then you got to look at this one breaking. So just keep in mind, under here, there isn't a lot of support. The key to me is going to be this 4-hour MACD. Every time lately it's been oversold, the markets have rallied. If this time both these indexes work off any kind of oversold by this line getting back to zero, the red line, and these futzing around right here, then I think then the MACD will have enough ammunition to plow lower and have that another leg down. And that's what we're going to be watching next week. Like I said, there isn't a lot of impetus to buy it unless the bond market rallies. Now, that's the thing I wanted to zoom out. There's the NASDAQ on the right. There's the ES on the left. Those better hold. I had those in there earlier in the week. Everybody thought I was crazy but when the markets rallied, but that is still valid. The bigger deal is how they work off the oversold. But for now, unless I see the bonds rally, I'm going to short every equity rally. Have a great weekend. Hope you enjoyed the video. Take care.